Hi everyone, welcome to our annual update for the Eagle Fund. Before we get started, we would like to extend our gratitude to our faculty advisor, Brad Andrew. This experience truly would not be as immersive or influential without his unwavering support and guidance throughout the year. We would also like to extend our gratitude to all of you for attending our presentation today. We're excited to have Dan Sunderland in the audience with us, and we're very excited to present. This is our biggest portfolio manager group ever, so let's get into it.
So first of all, before we start, we'd like to give a disclaimer. All investment and investment strategies contain risk of loss. Nothing in this presentation should be construed as investment advice. Any reference to an investment's past or potential performance is not and should not be construed as a recommendation or a guarantee of any specific outcome or profit.
Now that we've provided our disclaimer, we would like to give credit to Aidan Duran for taking this picture of all of us a few weeks back. So let's go ahead and meet this year's Eagle Fund portfolio managers. My name is Amy Buffington. I'm a senior, and my program of emphasis is financial management.
My name is Mason Hardy. I'm a senior, and my program of emphasis is finance.
My name is Prash Katka. I'm a sophomore, and my program of emphasis is economics and applied mathematics.
My name is Shayan, and I'm a junior studying financial data science.
My name is Tyson Carter. I am a senior, and my program of emphasis is finance.
My name is Dan Cummins. I'm a senior, and my POE is accounting.
My name is Corey Daniels. I'm a senior, and my POE is finance.
My name is Maddie Angar. I am a sophomore, and my POE is computational economics.
My name is Wyatt Ledabor. I'm a junior, and I'm studying finance.
My name is Alex Santa. I'm a senior studying environmental policy and economics.
My name is Curtis Sowers. I'm a senior, and my POE is finance.
My name is Sebastian Tringali. I am a senior, and I'm studying business management. So we're going to start off with our agenda for today. The beginning is going to be an introduction, basically how the fund was created. We're going to follow that up with macro environment, which is going to be inflation and interest rates. Next, we're going to get into fund allocation, which is going to be our IPS, and if we're in compliance with our IPS. Next, we're going to give some fund updates on securities we bought, securities we sold, and a security we wish we bought. Next, we're going to get into diversifiers, which is something we've been studying a lot this semester, and we're excited to share some of the information we've learned. And then we're going to wrap it up with performance, which is how we have done relative to our benchmark. So, as Amy said, we have a lot of people up here. So we decided it was best to split into two teams. So team 1 is going to stay up here and do 1 through 3, and team 2 is going to sit down. They're going to do 4 through 6, and we're going to flip about halfway through.
Here is where it all started. So the Eagles Fund began with $100,000 given by Claire Sunderland over 15 years ago, and we are happy to have here his son, Dan Sunderland. The fund is managed by students in a series of fund credit courses. It operates continuously, even during academic breaks, and all proceeds are reinvested into the fund. The class aims at providing students with skills and knowledge necessary for proficient portfolio management while we stay aligned with our IPS.
Speaking of an IPS or an investment policy statement is a document or an agreement between individual investors and portfolio managers. Now, in our case, we had to complete an IPS because our funds were donated originally by Mr. Sunderland. So what does our IPS include? It includes this ESG policy you see up on the board: environmental, social, and governance. These are 3 factors that we look at in any assets that we want to purchase. Now, our IPS is a little bit more open and flexible. All of the portfolio managers have a vote, and they get a say and get to voice concerns if we have any issues with any assets we might want to buy.
So in terms of monetary policy, there's some things you're going to want to know. The Fed, otherwise known as the Federal Reserve, within the Fed is the FOMC, or Federal Open Market Committee, who's responsible for setting monetary policy and deciding where the federal fund rate sits at. As many of you know, COVID-19 had a significant impact on our economy, primarily the supply chain. Supply chain took a hit and essentially supply decreased. However, demand stayed the same. And when that happens, that results in a soar in prices, which is indicative of inflation. Due to that inflation, as you can see, the Fed implemented 11 consecutive rate hikes, which reached a 23-year high. Currently, the federal funds rate currently sits at 5.25 to 5.5% and has remained unchanged for the last 8 months. Fed Chair Jerome Powell once said, "Without price stability, the economy does not work for anyone." So it's important to note why the Fed implemented those rate hikes. And the Fed has essentially been on a mission to come to a soft landing that combats inflation and prevents triggering another recession. As you can see here, it's just a clearer graphic of what those 11 consecutive rate hikes look like. Starting off in March of 2022, where interest rates were around 0 at 0.25% to 5%, those 11 consecutive rate hikes led interest rates to get all the way to 5.25 to 5%. Now, why is that significant? The interest rates have never really been at 5% since the last 23 years during the dot-com bust. It's essential to note that inflation was so significant that it resulted in these 11 consecutive rate hikes and being over 5%, and it's representative of what the Fed did to combat this inflation.
So now that we're on the topic of inflation, the CPI index rose 3.5% over the last 12 months, indicating that there's still a slight upward pressure on the prices of goods and services. This follows January, where it was at 3.1%, and February was at 3.2%. Currently, this is 30 basis points higher than what it was at the end of 2023, which is somewhat concerning news because the Fed ideally wanted inflation to decrease, but since it increased, this might speculate rate cuts in June.
Now, the Fed is constantly looking forward as to what the macro environment is going to look like, as are we. So in the December 2023 meeting, the Fed decided on rate cuts, 3 rate cuts that would hope to get us by a rate of 4.6% by the year's end. Now, like Wyatt mentioned, with inflation being what it is, this is at jeopardy. However, these rate cuts do suggest that the economy itself is doing well.
So the All-Country World Index is a stock index consisting of 3,000 companies from 23 developed markets and 25 emerging markets. As you can see, it had a really good return in the last 12 months of 14.55% with a high of $110 and a low of 88.
Moving on to the bond market, we talk about the Bloomberg Aggregate Bond Index. In 2023, the Bloomberg Aggregate Bond Index rebounded by 3.7% after a 16% decline in the previous year. And the Bloomberg Aggregate Bond Index covers US investment grade bond market. The US Treasury yields rose initially due to rising Fed rates, but they fell down during the final quarter of 2023 because of lower inflation and the weaker dollar. Shorter terms seem to perform better, rising by 2% with fewer drawdowns, while long-term bonds had lower returns. We talk about the equity and bond market here because our benchmark consists of 90% being the All-Country World Index and the remaining 10% being the Bloomberg Aggregate Bond Index, since our portfolio is equity-like and adding fixed income provides diversification.
As you can see up here, this is the current allocation of our portfolio. To the left are our 4 main strategies: buy and hold, which we have a benchmark of 30 to 40%, value play securities, which we have a benchmark of 25 to 30%, asset class momentum with 25 to 30%, and hedge at 10 to 15%. Now, our largest holding in our allocation of our portfolio was buy and hold, which came in at 28%, which was just off by 2%, but we like to see that it's close to our benchmark. Value play securities, which as you can see, are actually comprised of 2 strategies, with the main strategy being fundamental value. You might ask, why is there 2 strategies that consist of 1? Well, our IPS actually allows for a subset strategy to be within a core strategy. That actually came in at 25%, which is exactly where we want it to be. Moving on to asset class momentum, we came in at 27%, which is right in the middle of where we want our benchmark to be. And our hedge portion, which is supposed to be at 10 to 15%, actually was about 5% ahead, coming in at 20%. And we'll get into that a little bit more later of why that happened. but it's particularly because a few securities performed quite well.
As Mason just mentioned, the largest portion of our portfolio is invested in buy and hold. Now, buy and hold asset classes is probably a strategy you've heard of before. It's a traditional passive income strategy where you buy and hold asset classes regardless of short-term fluctuations in the market. This allows us exposure to the more traditional asset classes such as equities, real estates, and bond. And like all of our other parts of our portfolio, this is rebalanced on the third week of the fall semester each year.
So now coming to the buy and hold value strategy. So this is where we try to invest in undervalued securities with the hope that the market is going to correct itself within 3 to 5 years. We use fundamental analysis and a basket approach. Briefly speaking, a basket approach is where we divide the enterprise value with the operating income of a company to evaluate the company, and it is a form of diversification because it is uncorrelated with momentum, which we will get into soon. And the Eagle fund rebalancing occurs at the third week of fall semester.
Our asset class momentum strategy is based on research by our faculty advisor, Dr. Brad Andrew, also commonly known as BA. It buys the 3 best performing asset classes over a 6-month look back period, and the strategy thrives over a period of 3 to 12 months, with any underperforming assets below their 10-month moving average liquefied into cash. So our current top 3 are SPY, SPDR, S&P 500 ETF, AMID Argent Mid Cap ETF, UG Vanguard Growth ETF. Additionally, the strategy has a low positive correlation, like Cheyenne mentioned, with the buy and hold asset class, which provides diversification.
So the asset class momentum capitalizes on 3 particular behavioral biases. Primarily, we have the recency bias, which is the tendency for individuals to heavily rely on information that is immediately available to them in order to predict the future of that particular asset class. A good example of this is the Bitcoin rally that we recently witnessed. Next, we have the confirmation bias, which is an individual's tendency to believe that an asset is good or bad, and then they will find consecutive information to feed on that preconceived notion. And finally, and most importantly, we have the herding bias, which is the tendency for the consensus to stick together after they have this belief that an investment vehicle is either good or bad. As portfolio managers, we capitalize on these biases that exist within the consensus and profit off of them.
So next we're going to be talking about the hedge strategy portion of the portfolio, which, as Mason said, currently makes up 20% of the overall portfolio, which is 5% above compliance with our IPS. That is because this class has performed extremely well since our last rebalance. So now we're going to get into some of the prerogatives of hedge. It aims to limit the downside of the fund. It reduces volatility and downsides that harm compound growth, and it protects against unforeseen market events and changes. So think of this as insurance for your portfolio. It protects you against some of the drastic downsides, especially in the equity market. A great example of this came in 2022 when the equity market didn't perform very well. Hedge was there to keep your portfolio above water and keep getting you to reap the benefits of compound growth.
So our hedge holdings are 20% of our entire portfolio, and they consist of the following, which I will talk about. Primarily, we have the Bank of America and Wells Fargo preferred shares. Preferred shares act as debt instruments, giving you a steady and consistent stream of income. In the event of a liquidation or when dividends are paid, we also get priority. Second, you can see the Simplify US equity, which provides us with large cap exposure. This is a lot less volatile compared to mid, small, or micro cap. Next, we have the Vanguard Short-Term Treasury ETF, which provides you with steady short-term cash needs alongside number 7, which is cash and cash investments itself. Because it's short-term, its returns are also much more predictable. We also have the Standpoint Multi-Asset Investor All-Weather Strategy, which my colleague Mason Hardy is going to speak about shortly. Essentially, it is a macro strategy which concerns managed futures. We also have the Cambria Tail ETF, which helps us hedge against tail risk, essentially by purchasing deep out of the money puts against the S&P 500 as well as US Treasuries.
So Prash did a great job explaining all of our hedge holdings. Here's just a better representation of what our hedge allocation looks like. We mentioned how it came in at 20%, which is a little bit above our benchmark. That's primarily because, as you can see, in the 43% of our VGSH holding and our remix holding. As Prash mentioned, the remix is an all-weather approach, so it has holdings in various different asset classes, and we were glad to see that those asset classes actually performed pretty well. So opposite to what Seb was saying about providing insurance, they actually provided us some positive returns, which actually bolstered our benchmark outside of 15 to 20%. You also might be asking, how was large cap equity exposure necessarily a hedge holding with that SPYC holding? That's because within SPYC, it has large cap exposure, but within the ETF, it has actually options that are embedded. So when there's a market trend downward or upwards, you can capture the premium that is involved by exercising those options, which provides convexity, which is what you want to see as a part of your hedge portfolio.
We will now transition to Team 2.
All right, for the second part of the presentation, we're going to start with our transactions for this year from the Eagle Fund. We'll go through our annual rebalance, which occurs in the third week of the fall semester, our purchase of Rave, a pizza franchiser based in Texas, our purchase of the Crane Shares California Carbon Allowance ETF, easier to say KCCA, which allows us to break into the California Carbon Allowance market. We're going to go more in depth into that, and also our purchase of Charles Schwab after the collapse of the Silicon Valley Bank.
In addition to these transactions, we will also be discussing our research, which includes a look back to Hovnanian, a deep dive into our Rave analysis, an exploration on our interest in Crane shares, and a discussion surrounding alternative diversification.
So first, we're going to be taking a look at our annual rebalance. Our faculty overseer, BA, helped us with the annual rebalance. And during this rebalance, we sold parts of our hedge and momentum strategies in order for us to purchase assets for our buy and hold asset class strategy. When we did do this rebalance, it put us in compliance with our IPS, but due to some market movements in the past couple of months, we are no longer in compliance and are out of our target allocations, like Mason and Sebastian over there was saying earlier. In addition to this, we also rebalanced our acquires multiple strategy with data that was provided by some of the portfolio managers. Some of this strategy did not perform well, so we were forced to sell all but 2 of the securities for the cheapest options.
Now we will take a step back in time to discuss Hovnanian Enterprises. So for those of you who attended the presentation last year, this company may sound familiar to you. That is because it was a huge part of the spring 2023 research. So as a reminder, Hovnanian Enterprises designs, constructs, markets, and sells residential homes in the United States. The portfolio managers initially became interested in Hovnanian Enterprises due to several economic conditions that act in their favor. These economic conditions include a surge in millennials entering the housing market, while there has also been fewer existing homes in the market. Essentially what this means is that the supply of existing homes is not meeting the demand of home buyers. This forces home buyers to turn to companies like Hovnanian, who are building new homes to meet their demands. Outside of these economic conditions, Hovnanian operates in the construction and home building industry. This industry has been deemed relatively durable due to the need that there's always new houses being built and a historically low supply of existing homes. Ultimately, we determined that Hovnanian is a leveraged home builder with both product and market diversification due to their various operations across the United States.
At the time of this research, Hovnanian showed very high promise with their leverage returns and their high return on equity. As a reminder, the portfolio managers did not purchase Hovnanian. Instead, a new opportunity arose with the collapse of the Silicon Valley Bank. So portfolio managers decided to pause their research on Hovnanian, and they instead decided to look into the sudden drop of the price of Charles Schwab. In the past year, however, Hovnanian has almost tripled in price value, and it makes it easy for a lot of people to think that they're the one that got away for us. But still, Charles Schwab has shown very respectable gains in the past year, and we do support this buy because they are a very large company and they can be held on to for many years.
We also oversaw the purchase of Rave Restaurant Group. They're a pizza franchisor based out of Texas with franchisees in the South Central and Southeastern United States. We currently hold a 2.5% position in Rave, and that is part of our value play strategy.
A large reason why we also decided to buy Rave is that they have a capital-light business model using OPM, otherwise known as other people's money. Essentially what that means is that they have a franchise model in place where the franchisees are actually investing in the locations, which saves a lot of money and capital from the actual company having to invest in those locations and allows for more room for growth and profit. Another main reason why we bought Rave was they have outstanding executive leadership, starting at the head of the company with their CEO, Brandon Solano. Prior to coming to Rave, Brandon Solano spent 6 years with Domino's, where he was Vice President of Innovation and Vice President of Development, where in his 6-year tenure, he helped grow the stock price over 425%, which is almost unheard of. And then after Domino's, he took about 1.5 years with Wendy's, where he was operating marketer and senior vice president. With just in 1.5 years, he helped that stock price rise over 25%. We also have just read about how Rave also just added 6 new executives who sort of demonstrate the same sort of experience that Brandon Solano has had in his previous companies, where they have a proven track record of steering companies towards financial success, have effective initiative planning, and strategic decision making. Rave has also posted 15 consecutive quarters of profit, which is great to see. And as a part of our value play security, we look forward to continuing to see this growth.
Next, we also purchased the Crane Shares California Carbon Allowance Strategy ETF, more popularly known as KCCA. This is a part of our RST3, or Relative Strength Strategy, and is highly uncorrelated to our dominant asset classes. KCCA allows us to have exposure to our cap and trade carbon allowance and is benchmarked to the IHA Market CCA index. Since its inception, it has returned 8.97%.
So we bought the Crane shares during the fall semester, but we actually sold it 2 months after because it dropped out of the top 3 asset classes within our momentum strategy. This was the 11th asset class within our momentum strategy, and when we sold it, we ended up buying AMID.
Now we will transition our discussion to our research on alternative diversification. Now you might be wondering why we spent so long on this topic, but our research really aimed to figure out how important alternative diversification is, not only to the stability and health of the Eagle Fund, but for the economy as a whole. The last 40 years have showcased untraditional economic conditions. These conditions include inflation and interest rates falling, while economic growth has remained relatively stable. This stability has created an ideal environment for stocks and real estate. However, this stability is not guaranteed to continue. Many investors are now shaping their portfolio philosophy around the assumption that it will continue. So we would consider this to be a recency bias. Chris Cole, who we'll discuss in a few more slides, was quoted saying that recency bias has now become a systemic risk in investing. So essentially what this means is that investors are now avoiding asset classes that protect against economic outcomes that haven't occurred during their life memory. Essentially, they're making decisions based on current economic conditions or what have happened recently. Our research has indicated that it is still important for investors to have diversified portfolios that perform well in a variety of economic conditions. Luckily for us and all investors, there's an increasing number of ETFs who offer exposure to these alternative diversification strategies.
One of these alternative diversification strategies is the Standpoint Multi-Asset Fund, also known as REMIX. Standpoint Multi-Asset Fund was founded by Eric Crittenden and his team at Standpoint Asset Management. It is a mutual fund for investors looking for an all-weather solution to their investment needs. It diversifies across geographic regions, asset classes, and investment styles, and allows us to encompass assets such as currency, managed futures, and global equities.
Two main investment vehicles drive Standpoint's portfolio, those two being ETFs and managed futures. Managed futures is a long-short approach to all of the world's market and is highly beneficial to investment performance. Yes, we hold this in addition to some of our most traditional strategies. And while managed futures are more speculative than other funds, which could indicate that they do hold more risk for us, we do hold this because it helps us diversify our portfolio, and it also helps us reduce risk whenever the stocks underperform or hedge fund returns flatten.
So now, as Amy hinted at before, we're going to talk about Chris Cole and his Dragon portfolio. This is similar to Remix because it is an all-weather portfolio, and we're going to talk about what it is, which it's made up of equity-linked, which is 24% of the portfolio, made up of U.S. stocks and global equities. These perform well within booming economies. Next up is 18% of the portfolio is fixed income, made up of government and corporate bonds, working well during low interest rates. Then we have 19% of fiat alternatives, which is gold and crypto, which we cannot invest in because of our IPS. These perform well during high inflation times. Next up, we have 18% is commodity trend, which is active futures and shorting commodities. This performs well during crisis times for stocks and bonds. And then lastly, we have 21% is long volatility, which is made up of active options, which performs well during crisis times for an economy.
So the question we have to answer is, how exactly is this portfolio alternative? The average retirement portfolio in the US is 94% in stocks and bonds. In this portfolio, that's 40%. Now the reason that is because these 60% in fiat alternatives, commodity trend, and long volatility, it allows us to diversify into economic conditions we've not experienced in the past 40 years, as Amy referenced. So when there's inflation, deflation, the economy's volatile, and when it's stable, this portfolio still makes money. Chris Cole backtested this portfolio over 100 years and outperformed the 60-40 portfolio by several factors of 10. So this portfolio diversified against all economic regimes that have occurred since the Great Depression.
So after doing this research on Chris Cole's portfolio, we understand that you cannot buy the portfolio as a whole. So we made the Bearded Dragon portfolio, which is an ETF-based replication of Cole's Dragon portfolio. Its weighted average expense ratio is 0.42%. The only problem with it is we cannot short commodities, and there is no active management within the long volatility.
And to break down this portfolio, it's 24% equity links. That's 12% in U.S. equities, 12% international equities. Then we have 18% in fixed income, 14% in U.S. bonds, 4% international bonds. We put 19% in GLD, which is a gold ETF linked to the price of gold. That's our fiat alternative. We have 18% in COM, which is a commodity direction ETF. Now this ETF tracks the trends of commodities in an upward direction, but as Corey mentioned, we can't short commodities ourselves, and within the ETF, when commodities start to exhibit signals they're going to go downward, the fund converts them to cash. And as for the VIXM and VIXY, those are two index funds that track the VIX index. That's an index that tracks volatility within the market. The disadvantage of these two ETFs is we are constantly tracking and paying for volatility. Whereas under Cole's active option strategy for long volatility, he can choose when and where to invest in volatility to take advantage of market melt-ups and melt-downs. Despite these drawbacks, this portfolio allows an approximation of Chris Cole's portfolio while still remaining within the Eagle Fund's IPS.
So to break down our performance over the last year, the Eagle Fund had a great year. Coming in at last year, we were just about at $244,900. This year, we helped grow that to $259,000. You know, it was great to see, especially going back to last year when we had a negative 3.57 return, for that to grow and bolster upwards into 5.8%. Now, Maddie and Cheyenne mentioned earlier our ACWI, All World Country Index, and our Bloomberg Aggregate Bond Index, AGG. That's what we use here on the right for our weighted benchmark, with 90% allocation towards ACWI and 10% towards AGG. Now, we were a little bit off of our benchmark, but it's great to see that success has came to our portfolio and we're back on the upwards trend. We look forward to continuing this growth with our group next year. Thank you.
Say it.
All right, everybody. I'm BA, the faculty overseer for the Eagle Fund, and now is the time where you can ask questions of our portfolio managers. So I will I'll do my best Oprah impression and run out in the audience and hand the microphone. Please wait for the microphone because we have, this is being recorded and shown right now online and will be recorded and also put on YouTube and on our website as well. So we want to be able to hear the questions too. So here's Dan Sunderland.
First of all, I just want to congratulate all of you. What a fantastic job. You should all be super proud. When my dad came up with the idea to donate $100,000 to the Eagle Fund, it was partially because of his love for investing himself. He was so motivated to do it and follow his own success and failure that he wanted that the Juniata students to feel the same thing. And he truly felt by investing real dollars rather than, I'll call it monopoly money, that you would get more out of it. So I know that my dad is in heaven now and he is smiling because of all the great work you've done. So thank you. I have one question for you that so many of you said that you're seniors and so many of you said that you're in the finance field. And I think all the seniors, I just want to say it's an exciting future that you have ahead of you. But for those, at least one or two of you that are in the finance field, while you're interviewing for jobs, please tell me how the Eagle Fund and this class has impacted, and have you been able to talk about this in any of your interviews?
Yeah, I'll go ahead and answer that. So I am a senior. I'm in the 3+1 program here, so technically it is my third year. I'm happy to say that I'm returning back for a second year interning at JP Morgan this summer. And during my interview process, you know, tons of questions will come up on what practical things are you doing in your community, or what practical things are you involved in school. And I love to mention the Eagle Fund just because it is actual money. It's not monopoly money. And when I talk about this in the interview process, you know, a lot of times, a lot of the people working at the company were a bit wowed by the fact that all of us, you know, have such large of an impact in decision making on $100,000 worth of a portfolio, which we have happily grown to almost $260,000. And it's a class that we all enjoy and really have gotten a lot out of.
Thank you so much for your question. So I'm a senior as well. I'll be starting at Vanguard in about a month. And in my interview process, this was actually something that was brought up to me a lot. A lot of recruiters, a lot of interviewers thought it was an incredibly great opportunity to have this hands-on experience. And it also gives them a sense that we're doing this, we have exposure to this now, and we're loving it, we're interested, we want to pursue this in a career.
Yeah, I'm also a senior, and it was absolutely, like, during interviews, they would ask me about, you know, is there any kind of real world experience that you've had within classes? And the fact that I tell them, you know, we manage a portfolio that's worth over $100,000, they always seem surprised in how much vote we have within it, and it really is a great thing.
Yeah, I'm actually a junior, and I'm not necessarily sure if that I want to be in the finance sector, because currently right now I do sales, I sell solar panels. So I actually had one interview with Equitable Holdings in New York City, and just being able to talk about the Eagle Fund and how we've grown the profitability of it, it was something that he really thought that was cool to hear, and yeah, he gave me the job, so we'll have to see.
Yeah, congratulations. Elaine Jones, I'm currently the trustee that chairs the investments committee here at Juniata, so really great job. Have you all heard the saying, did the dogs eat the dog food? That's something that you hear investors say a lot. So I'm quite interested in the rave selection. You wouldn't think a pizza thing might be a high yielding opportunity. So my question is, does anybody eat the pizza? Because it's as much about the product as it is maybe about other things before you made the investment.
Yeah, so most of their regions are not in the PA area. Most other regions are in, South Central, so sort of Texas-ish, and they have some in Virginia as well. As we alluded to, a large factor, it is a part of our value play securities, and during our research, we really took a deep dive with the financials and sort of how can this security be so undervalued, and we kind of came to the position that we understand and know the business model, and that over time other people will become more aware of it. As we alluded to, their executive leadership has done a great job of growing companies over time, and they use other people's money and have a very light business capital model. So we just think that in terms of value, we attempted to capture the value while it was still priced fairly lower. We purchased the security at less than $2, and its all-time high is $11. So by purchasing a good amount of shares in that security, we thought that over time we'd be able to capture that value.
Does Mason, Amy, or Prash want to mention Justin Toney, a former portfolio manager? Yeah.
Yes, we did a little bit of research based on would we actually eat the pizza, and their slogan was 5 minute fast and fresh. So Justin Toney, he will be remembered, discovered that all the ingredients are freshly sourced, including the cheese. So compared to other restaurant chains, for example, Domino's or Pizza Hut, their ingredients were much fresher, so we believe that people would enjoy it because it was a little bit of a more different sort of business than the traditional fast food business as well.
Justin Toney's grandparents actually live in Texas, so we sent them to go scout out a few rave locations, and they did eat the pizza. So somebody tried it. They gave us a good report, but in addition to his grandparents' reports, we also looked at hundreds and hundreds of reviews for their locations across the country.
So you mentioned like the dog eating their own dog food, right? I myself bought Rave like 2 days ago because of all the reasons my colleague mentioned, and we think it's going to be a hit in the future.
Okay, so we've been talking about all of the successes. I'm Carol Pletcher. I want you to share, how do you feel about letting that home builder get away? Because I'm looking at this thing and I'm going, oh no, they did not do it. So, oh no, you did not do it. So how did you all feel about that?
It was definitely sad that we didn't go for it. Obviously, hindsight is 2020. We could have, we should have, maybe. But Charles Schwab has proven itself to be a really good investment strategy in the long run. And I think I speak for all of us when I say that was probably the best bet.
Oh, I'm not sure. All right, excuse me. Sorry.
Yeah, it wasn't great to see that one get away. That's for sure. We certainly would have loved to triple our investment. But our plan was to thoroughly research each option and choose what we thought was best at the time. We were wrong.
Now, it is good to see that in terms of value play, after the banking crisis, Charles Schwab took a massive hit, and after taking that hit, they purchased TD Ameritrade. They went to a no-fee basis, and they were able to generate a lot of business. So in terms of value, the value plummeted, but over the last 6 months, they've had over a 40% return. So we think that in terms of capturing that value, in terms of a security like Hovnanian that was already experiencing a little bit of momentum, that we're okay with the fact that we were able to generate stable returns with Schwab, and they're a bank that some will consider is too big to fail, and like Tyson mentioned, can be held for a long time.
I'm Pat Chris from the baseball coach here. I know it was referenced at the beginning of how big this group is. If you would all, or some may want to share your experiences as working together, and if that was easy, if that was hard, or what that experience looked like when you're talking about research, but also what to decide. I know it mentioned you voted on things. Could you talk about that process? And you could share the good, the bad, and the ugly, I guess, if you want to with that. But
I would definitely like to say that Amy has been such a good senior portfolio manager and that she really deserved that job at Vanguard. And my other colleagues are just as impressive. Mason right here, he is like a wealth of technical knowledge. So I think we all do a pretty good job of bringing different skill sets to the table to be able to understand kind of different industries. For example, I'm really interested in finance. So for example, I like studying Charles Schwab. My different peers had different interests. So I think bringing all of our interests, but also our skills together, I think we make a great team, and I will miss a lot of my team next year.
Yeah, I would say it was a pretty fun experience, especially in the first semester. It required a lot of, weekly meetings, coming together with my senior portfolio managers and just looking over 10Ks, looking over different financials, and just looking over what was the best decision to make. And I think it is a really cool aspect of the Eagle Fund, how, when it came to rave, we all had a vote. If the majority wasn't in for it, we weren't going to buy it. And like we alluded to earlier, that's really great in terms of, real world experience where we can actually see the, positives and downside to the decisions that we make.
I'm Jeff Skosha, Vice President for Finance and Business Affairs here. I'm curious, after going through this class and this exercise and having the experience over the last year, do any of you have any lessons learned that you would like to share with the rest of us?
It's hard to beat the market. I learned through this, not just this course, but also the series of investment courses leading up to this, how to invest in a smart manner, not to speculate, not to spend my hard-earned money on things that are going to go way up and way down. I learned to get a steady return, to diversify, and to really help my money grow in the long term.
I think what we also learned was the importance of long-term planning and sticking to your plan. A lot of investors tend to suffer from loss aversion, where they don't want to experience so many losses, so they change up their strategy or they change the way they do things. But within our IPS, having those structured 4 categories, which we like to stay in our benchmark with, has really taught us to trust our investments and when it comes time, rebalance accordingly.
Yeah, and to bounce off of what they said, I think learning the different strategies is definitely an important thing, and also that you can't do enough research, like just to not make a decision of, oh, I think this stock will do well, and research it deeply into your decision.
So I'm Sadie. I'm actually a student that goes here, and I know you guys were just talking about rave and how you chose a business that's like more out in the other states, and you keep talking about the research process. I want to know what type of research, what did you look into for these different businesses to choose which ones you wanted to invest in, why you didn't invest in certain ones, and why you took the time to either put ones to the side that you thought would be good and go with a different business, or just choose to not go with those?
As for what we looked for in research, a lot of it was the company's own website. So for Standpoint, for example, we did a pretty in-depth analysis of the website, who the owner and operators are, the executive membership of the company, the long-term returns over a course of years, whether they're hitting the benchmarks and things like that.
We also looked at a lot of fundamentals. So like if you go up to Yahoo Finance or anything of that sort, you'll be able to see their EBITDA, enterprise value, things as such. So if you were trying to replicate it, that's where I would go to kind of make the analysis between different stocks or several other assets.
And depending on our strategy, some of the research is automatic. So for the acquirers multiple strategy, for instance, there's a cutoff for the certain number of stocks that we buy. Same thing for our momentum strategy. So there are certain strategies where there's an objective benchmark, and then some, like our buy and hold strategy, is more of a value judgment based on those fundamentals, executive leadership, and extraneous factors.
So I want to start off by saying good job, guys. So during the past year, the Eagle Fund returned 5.8%, and during that same time period, the U.S. stock market returned 20.5%. So my question is it worth continuing the all-weather strategy, and does the opportunity cost of missing out on those gains outweigh the risk?
So we absolutely think it's worth continuing the all-weather strategy. Our idea with the Eagle Fund is stable growth in all economic regimes. Right, so we're not going to capture all of the upside in a great year like this, but we're also not going to take all of the downside in a bad year like 2022, like 2020. I think in both of those years, the Eagle Fund outperformed its benchmark because it didn't lose as much money.
Yeah, and as we mentioned, the All Country World Index, which is sort of representative of the equity market, that index is actually 15% weighted in what we like to call the magnificent seven stocks, which are your top stocks by market cap. So for like a stock like NVIDIA that had over a 293% return and helped bolster the overall equity market, like those 7 other stocks did, we're not individually invested in those stocks, which is why we were a little bit off of our benchmark. But like Dan alluded to, it sort of protects us in all different investment environments, not just when the equity market's doing well, not just when the fixed income market's doing well, but we like to see that we're covered holistically.
Sorry, what? On Zoom, okay. All right. Question on Zoom from Ryan Huggy Bear Hughes. All right. Those baseball players will know actually everyone would know Huggy Bear because he did everything on campus. But he was a catcher on the baseball team. What are some downsides, if any, to RAVE and KCCA that made y'all hesitant to invest? Go ahead.
So one of the downsides to RAVE was that we did purchase it right around 1.8, so $1.80, and it was even smaller than a nano-cap stock. So we were just kind of reluctant at first to see if the stock was really going to have any movement. Within the last 2 years, it didn't really go up more than 50 cents on the year. So we were just a little bit reluctant to see if that stock was actually going to have growth. But when we researched things like their executive team and their capital light business model, we saw that the upside probably was more favorable than the downsides.
And in terms of KCCA, I think we also explored another cap and trade carbon exposure called Carbon, KRBN, and that was more global. So we were between the decision of investing in a California-only strategy or a more global strategy. However, we decided to go with KCCA, and we believe that we made the right call with that as well.
How much did the increased emphasis or changed emphasis on ESG affect your investing?
So it didn't fully change anything. We've obviously always had these ethical and moral reasons for picking a stock or not picking a stock, but the addition definitely made us sure when something we felt was a little bit off. So one of the best examples of this is we used to be invested in a company that farmed chickens, I believe, and there was some controversy over whether the chickens were being treated well. So one of the portfolio managers called the company investor relations and was asking questions and got shut down pretty quickly. So based on our ESG policy, we felt that it was worth it to sell that stock. And a majority of portfolio managers agreed with that. So we did end up selling it. But it hasn't really changed anything wholesale.
We've also avoided any stocks that have to do with gambling or wagering with the proliferation of sports betting in different states. We don't invest into any of those stocks due to the social concerns.
Got one more back there. Did the level of inflation impact the decision to invest, divest in any particular securities?
So in our choices made this year, inflation did not play much of a role in terms of Rave, KCCA, and Schwab, just because these were equities that should keep track with inflation with company earnings. But if we were to buy more of a certain fixed income, if we're looking at commodity trend, then inflation might play more of a role.
Any other questions?
Going once, going twice.
All right, we're out of here.
All right, thank you. Great job, great job. Thank you everyone for coming. I just want you to know, you don't need to be a business POE to be a member of the Eagle Fund. If you want, there have been people from all POEs, but many different POEs over the years who just take the sequence of courses and have become portfolio managers for the Eagle Fund. So if you're interested, just contact me and I'll give you some advice on what to do. So thank you again. Thank you.